Hello, everybody, and welcome to Mindprint Hash for week 12 of 2026. I'm your host, Cameron Otsuka, and my co host today, as always, is Matt Dines. This week, we've had a few
Hello.
key developments in the integration of digital assets into the US and UK's monetary rails. Really, it's a print turning into a hash story. But these are all part of a broader kind of competition of ideas around central bank independence that I know Matt's going to help us better understand. So he'll first go through what does he mean by, or what do we mean by central bank independence? We'll use the US and UK for that kind of policy comparison. And then we'll kind of wrap it all up, tie it in a nice little bow for you all in terms of showing how it's playing out in the actual markets. So, with that all in mind here, I'm going to flip us to the starting slide that we had up here first, which is this money madness bracket. Matt spent some time putting this together. I think it's a great, fun little visualization. But maybe Matt, as we were looking at this bracket and kind of digesting what it all means, can you maybe explain what you mean by central bank independence in your mind?
Yeah, so to set the stage here, today is the opening day of the NCAA tournament in the US, where most of our audience is, but we do have some people checking in across the globe who are not situated in an office in the United States right now, where everybody's filling out their brackets. We're just one upset away from everybody's predictions turning into rubble here, but. Yeah, I figured we'd have fun with that today and talk about the monetary madness going on while it is March Madness. Um, Everything we're seeing play out in Iran, I think if we zoom out and take a picture of what's going on in terms of the capital wars, and we'll get into that. Um, I think we'll have an interesting way to look at the situation as opposed to, I think right now, if you just go follow on X, the media, etc., it's very difficult to distinguish the signal from the noise. I think where things stand today. So we're going to start out just talking about central bank independence. We hear this term talked about a lot, um, but from a public discussion standpoint, there is kind of a lack of information on this topic, and I think that's naturally by design. So when we say bank independence, what does that actually mean? Well, think about on a sliding scale. It's a spectrum, right? There's never fully independent versus fully autonomous. But what it means if you crank that dial up to the right towards full central bank independence, what you're actually saying is these institutions, which at the end of the day can amount to, if allowed to go all the way in one direction, amount to a monetary cartel, private interests, however you want to describe it, that is not accountable to the public sector. What do I mean by the public sector? Well, think about your developed economies today. We call them the G7 right now. Um, Basically, your allied powers who were victorious after World War II and the framework they set up, and then you've added a few new tag along. So Japan, um, or Japan, China coming in with the BOJ, BBOC, et cetera. Um, and if you measure that sliding spectrum, each one of these central banks will have achieved a different relative degree of independence than maybe some of its peers, right? So if you talk about on the extreme end, the most independent, and by that definition we mean the most outside of the public sector's purview of the central banks, would actually be the ECB in the hallmark. It's got this supra sovereign, um, you
Right.
know,
It's above the countries. Yeah.
instantiation, right? That's set in treaty, all these things. So you've basically abdicated monetary authority from the sovereign EU states, which, are they even sovereign anymore? Maybe they're semi-sovereign now. Um, but they've abdicated that ownership uh, to a unelected, technocrat, bureaucrat, et cetera, um, who then has full control of monetary policy, right? When I say monetary policy, we'll get into that, but it really means down to and including this new frontier that is represented in call it the crypto industry, but it's really this thing that Bitcoin opened up, the new high seas, if you will, of money, greenfield, however you want to describe it, and this key battle going on within each kind of sovereign, nation state. Um, you're seeing it reflected as well in the regulatory approach that's slowly unfolding in this digital assets or crypto, or ultimately down to the studs, to how each of these states treats Bitcoin and incorporates that into its uh, economy, and financial system. So we'll get into that, the U.S. and U.K. here, as we unlock. But yeah, just the matchups here. Everybody's kind of familiar. The multipolar world, the globalized order is breaking down, and you've got basically a head-to-head. We got four regionals here: the Americas, Europe, call it Central Asia, East Asia. Those are your primary venues here in this tournament. And I think ultimately what you're looking for here is the champion here that emerges will kind of reset or establish the new monetary order for the 21st century. So um,
Yeah.
stakes are much higher than I think your typical NCAA tournament office pool. But Cameron, let's get into that. Talk about these regulations first, starting off with the U.S.
Yeah, so the first one, I put up here, this is based off of a new interpretation that the SEC put out, and this specifically are some highlights from Paul Atkins, current chairman of the SEC's speech, talking about those new interpretations. And the critical point here is what I've highlighted in yellow in the top right of your screens here. Not deemed securities are digital commodities, digital collectibles, digital tools, and payment stablecoins. I will note he did talk about digital securities, kind of in the concept or mind framework of tokenized securities. So taking your, I don't know, GameStop shares and tokenizing those. Those are very clearly, in their view, securities, but things like Bitcoin are a digital commodity, right? So do not fall under the security definition. There's another speech, I'm blanking on who that was from, but they also, I think it was titled The End of Howey or Moving On from Howey, something like that, referencing kind of the Howey test, kind of prior interpretation of what defines a security. But all to say, I mean, this is a pretty big new interpretation for digital assets. So Matt, help me understand how do you put this in that broader framework that we're talking about in terms of the U.S.'s different policy approach to these digital assets?
Yep. So what this is essentially, in the last few weeks, there's been a memorandum of understanding, an MOU signed between the different regulators that have jurisdiction or coverage over this new economy, this new frontier, within the purview of the United States, right? And then I'll compare and contrast that to what we just saw out of the UK. All right. But to start off, when you say that line, central bank independence, slide that scale up to the right, what you would have is one organization, call it in the US case, the Fed, would kind of set the perimeter, the regulatory perimeter, and encompass everything, right? And very clearly in the US, with what we just saw, this MOU, you don't have that, right? So we saw the carve out. Cameron, you mentioned these specific terms. Digital commodities, digital collectibles, digital tools. All right, those are one thing. Those were kind of agreed in this setting of the fence posts where the lines are drawn. Those are going to be in the CFTC's purview. And specific to that, I think about commodities trade, right? They're primarily concerned with basically just fairness and pricing, exchange, et cetera, for the goods that really go. Think about commodities, right? We're talking about it right now. Crude carriers traversing from point A to point B on the high seas. They're international transactions, right, involving the shipment of, say, a good across different um, sovereign boundaries, right? So
Right.
think about this, like CFTC is covering that side of this crypto industry, right? So there's a carve out. Immediately you see there is no um, extreme here where you would have, say, a central bank taking control over all kind of
Hmm.
monetary purview, right?
Right.
So you're carved up. You don't have one thing owning everything. And very specifically, these new assets that have cropped up. I mean, digital ledgers. Think about that. Like Bitcoin is a ledger money, right? But it exists in a new space. It exists nowhere, technically, everywhere and nowhere, right? You can flip on a node anywhere that's internet connected, um, be your own hub, and so the network kind of lives distributed. Um, you could say the same things, kind of, for other, blockchain tokens, et cetera, whatever utility tokens. They're not quite like none of them are doing exactly what Bitcoin is, which they're different products. But my
Yeah.
point is those things live in the CFTC's purview, which is kind of like think very kind of abstractly here, but it's the movement of goods from A to B, that type of thing, crossing international boundaries. And CFTC is kind of tasked with the responsibility of maintaining integrity, fairness, et cetera, for the pricing venue, settlement, and trade of these objects, right? Abstract objects in this case. All right, that's kind of telling, right? Because it doesn't fall into the Fed's framework, right? Which is like the private institutional control of money directly, like cartel owned. So the U.S. Regulatory standpoint, like you've got all different stakeholders, all different parties who want a piece of this new pie, right? How are we going to call this business? We're saying right now, like Fed is in the game, but they're not able to block this thing from happening. And we'll kind of see the approach where maybe other jurisdictions want to kind of capture this thing and ring fence it inside of one boundary where you would have, I guess, full central bank independence,
Well, maybe let's
which,
switch that to the
yeah, is
UK and
it?
talk about that then if you're gonna go there. So
Yeah,
the exact flip
yeah,
of that to your point, Matt, is the Bank of England released kind of their new proposed regulatory regime for sterling denominated systemic stablecoins. I specifically called out the section on unhosted wallets, and maybe I'll just briefly touch on that, which is basically they acknowledge that some participants, some comments reached out saying, "Hey, if I have my own wallet and I'm storing stablecoins in there, is that going to be legal under the new proposed framework?" And they basically tell you probably not, likely no. Here's some reasons why, and I'll let Matt explain kind of how that fits into this broader picture that maybe the BOE, how they view all of this fitting into their monetary framework.
yeah. So this idea of an unhosted wallet, right? Which, what do they mean by hosting? It's, you know, custodied by a centralized party, right? Who is enveloped inside of that perimeter we talked about of the regulator's ultimate control. So, unhosted wallets, at least in the UK standpoint, those are not wanted. Their monetary framework doesn't want to see that kind of take hold, so they are fighting this kind of new frontier, if you will, this emergent economy. And I think in contrast to the let's accommodate this thing, let's grow on top of this, disruptive innovation, all of that you're kind of seeing in the U.S. UK is taking the approach. We're going to try to, I guess what you'd say, like absorb and suppress. And why do I say that, right? Well, you go into the actual kind of regulatory kind of guidelines or statutes that they want to see implemented. And one of the pieces on this proposed regulatory framework was limiting holdings of customers and clients of these of stable coins on these hosted wallets. They want to limit that to 20,000 pounds, right? So what is that actually? So it's basically suppressing a like the same monetary unit, right? Pounds on a stablecoin standard, pound or on stablecoin rails versus pounds that are reflected in a bank deposit, which is a liability version of the same thing. What they're doing is they're effectively capping and suppressing UK residents, businesses, et cetera, from adopting this new rail. So it's really that take. If you think about central bank independence, it's a misnomer. It doesn't sound like what it means. What it means is control, like full control of monetary authority within a jurisdiction. We've known this. Like Badgett writes about this back in Civil War in the United States times, like mid 1800s, late 1800s. Even on a gold standard or precious metal standard, there was a recognition that you never really had full control of money within a jurisdiction, even on a precious metal standard. You never knew exactly the quantity of money in the economy at any given time. What you could do is execute monetary policy to kind of shepherd the way you wanted to guide the economy just based on how things were unfolding. But there was an acknowledgement you couldn't fully envelop and control the thing, right? You had to, it was an untamable beast. The best you could do is, animal husbandry and, learn to interact with this thing. Versus like this modern approach is really, when you have untethered monetary standard, everything's liability money, free floating exchange rates, all of that. I think there's this worldview from the central banks who want to maximize their control of money. It's like we want to control everything, right? So it on the other side of this, right? Like who are the other regulators? Well, in the U.S., one of the things we talked about that the U.S. split it out, right? We have digital assets, tools, collectibles, whatever, or digital commodities. And then number 4 was stable coins. Number 5 was tokenized securities, right? In the U.S., you have that framework where during the New Deal, FDR, 1930s, you had the kind of the overhaul to rein in a securities industry. When I talk about that, like think broker dealers, like equity, stocks, everything. There was a layer of kind of regulation put in place on the stock market itself, brokers, et cetera, to basically put some standards in place. That's where we get the SEC. In the UK and specifically in the US, right? This is a key differential, right? That universe where we talk about the securities complex, broker dealers, et cetera, that there's a fence post here that's been laid out finally for the first time in 10 to 15 years in what's been a gray area where the securities and commodities industry didn't quite know how to carve up that gray area. Well, in the U.S., that's been settled with this MOU, and the last step is get it into law, which is this Clarity Act. We expect to arrive here sometime in 2026. In the UK, you've got one entity, the FCA, Financial Conduct Authority, who is kind of the analog of the SEC in the United States, but they encompass everything. Right. So what you're getting from the UK with its proposed regulation of this new frontier is basically let's envelop it with our existing like bank regulator and securities regulator, and then we're gonna essentially suppress. And what it comes down to is control of capital. Right. What you don't want to see happen is capital leave your system. Right. And that's where we get into, we'll talk about gold in a second. But it's kind of one of those things, like thinking about a relationship. Whenever you try to hold on too tight, that's when things want to go, versus when you want to be more accommodative, incorporate this new technology, whatever. Well, it turns out usually that works better in life, relationships, all of the above. And you'll ultimately see capital attracted towards that. So, what would you be looking for if this framework was holding out, right? One approach versus the other. Well, start off, like we have this new stable coin, which is really just these stable coin, rails. Think about the amount of capital that's porting onto that and being built. And this is where the amount of uh, US dollar stable coins just dwarfs everybody else, like any other uh, sovereign currency, right? One of the things I called out this week, or I found uh, informative. Think about the drawdown that's been in place since the February 28th actions in Iran, right, in the Persian Gulf. We've seen the squeeze in oil, interest rates up across the board. We'll get into that in a second. Um, and basically, dollar strength would be the other kind of hallmark of what we've seen. And then you'd say softness in equities, kind of globally, right? It's a liquidity squeeze, right? But what you actually see happening in stablecoin world, USDC, the stablecoin from the Circle issuer, which is kind of a partnership with Coinbase in the U.S. Interesting dynamics there. You saw its issuance hit an all-time high. Now, it's not breaking out at this point, but there was, you can see it in the tail end of the chart for 2026. There was liquidity taking, issuance was redeemed, USDCs into bank deposits, closing out liquidity, all of that. But you're actually seeing issuance increase in USDC stablecoins, which is, the number two in market share behind Tether. It presents itself as like the regulated alternative and the, modern day Coke versus Pepsi challenge, right? But it's advancing in this liquidity kind of panic we've seen as everybody's rushing to get a hold of energy resources in this game of musical chairs that's playing out since the beginning of March in Iran and what's going on in the Persian Gulf. So I take that as a key sign. And then Cameron, you got one more slide here, just looking at individual issuance. Like the market is much bigger in US dollar denominated stablecoins than any other currency. We already mentioned that. But in terms of issuance and redemption, you've got, over $1 billion in circulation added this week in USDC, 30-day change. And this encompasses everything we've seen since the beginning of the Iran actions, that plus 5.7 billion. Cameron pulled this within the last 24 hours. So market is growing. People are flocking to USD stablecoins. Yep. And then on the other side of that, the euro equivalent, EURC, much smaller market, and businesses, people, the private economy's actual demand to hold euros on this kind of emergent growth rails that is represented in stable coins, blockchains, all of that. Euro demand is down during this time frame. So I think if you view this, what we're seeing in Iran is like one action in this bigger, I'd say conflict or engagement that's kinetic on some fronts, hits capital markets in on some fronts, it's technology on some fronts. Dollar is like continuing to win in the new arena, in my opinion. Cameron, any more on that?
I also thought it was interesting to see in the marketplace of ideas that is this world, you see it play out, very clearly in that circle chart. So that was super interesting to see the very stark differences in terms of issuance there.
Yep. This is coming. This is a multi-year story. It's got legs to it. And I think everybody who's watching, I mean, the key indicator in this process is, in my opinion, Bitcoin price. And for anybody who's been around like 10, 15 years, et cetera, everybody knows Bitcoin price goes into drawdowns. There's liquidity taking. It's really reflecting what's going on in the dollar complex, because and on the spot exchange rate, that is Bitcoins versus dollars, right? Bitcoin's monetary supply is fixed and certain. There's nothing changing there. There may be demand for Bitcoin use, like within the participants and that monetary network changing, from time to time. But by and large, the monetary processes, right? We know, the monetary policy issuance was, locked in with the Genesis block, and continues to operate every 10 minutes blocks as every 10 minutes blocks come in, right? Um, the real volatility, it's reflected on the US dollar side of the exchange rate. That's where the liquidity needs within the economy, the slowdown in growth, all of that's baking in, or the rising inflation that everybody's pricing in ever since the Iran actions began. That's where the volatility is taking hold. My point there, while we're in the middle of like what's roughly now a 50% drawdown, it may continue further from here, right? But every bear market, everybody wants to declare Bitcoin dead. My point here, you wouldn't be seeing these things like the battle to draw regulatory lines, even like within each sovereign jurisdiction itself, but also those sovereigns kind of competing with each other. They're going after the prize here, right? So my point here, let's chalk up another obituary for Bitcoin on top of like the hundreds or a thousand, the thousands we've already seen. But I think these actions you're seeing here to lay the groundwork for this new front, like that's that's your tell, right? That it's a bear market. There will be an upswing here, or expect an upswing as your base case as this process and adoption
Well, let's round
continues.
this out then with kind of bringing it back to the mine part of the story, which is gold, right? And so I was seeing a lot of hullabaloo about kind of the our net exports, sorry, our trade balance is improving, but the question was, why is that, right? Are we just importing less? Are we exporting more? What are we exporting specifically? And the stories seem to be in non-monetary gold, right? And so, for me, when I think of non-monetary gold, I think jewelry, I think just, I mean, bars of gold that you're not actually using for some type of collateral payment. But, Matt, you had an interesting set of kind of deep dives into this, and we'll get into those slides right after this. But maybe explain to me how this fits into what we've been talking about with central bank independence and some of this volatility that's going on as these, different ideas, these policy ideas are taking place.
Yep. So the non-monetary gold, it's not your coinage, it's not your struck bars, meeting exchange specific standards, all of that. It's your loose gold, right? As you described it in the economy. So think about those exports going out. When there's a price run up, like go read back on the great silver bull market of, the 1980 or 70s, and then culminating at the beginning of the 1980s, like the Hunt brothers, right? Um, as you see like the price run up, what people would do is they go in and just turn in their scrap silver. And what we mean by scrap here in this case, it may be your family heirlooms, your dining room, just heirloom sets, stuff like that. But they trade in their scrap metal. When I say they, like the private sector, households, business, anybody with like loose gold at high prices, price is your signal that suppliers in this case, just households, like they go and sell their metal, that they may have lying around the house into a dealer at these high prices. So with the run up from gold, basically at about $2,000 at the bottom of the interest rate cycle in 2022, 2023, and then the breakout from there. Um, um, you basically saw basically like gold running up 150% in that short time frame. What that did is that attracted that metal supply out of the private sector, and where it actually went was outside of the US economy, right? So it shipped overseas, it went somewhere, right? um, we kind of know where it had to go to Europe or China, right? There's only two main places it would go. But Cameron, if you go to the slide, I just want to look at like if you look at the month of January, right? Go to slide 8. Yeah, that run up where you see the blow off top, and let me say this may not be the final blow off top of a large bull run in gold. Like this thing may continue to go, but that process of U.S. households going to sell their gold to like a bullion dealer. they were doing that in January into higher and higher prices, right? So what that's telling you is despite more supply showing up, especially from the like coming from the United States, someone somewhere outside the United States was being squeezed to pay higher and higher prices as the month went on, right? So someone was kind of backed into a corner and had to pay these high prices. Who who was the kind of the beneficiary of those high prices? Well, it'd be the U.S. private sector, right? And so what you're looking at here, if you zoom out, you look at the economy, right? Um, these other these competing financial centers or regional spheres. If you go back to our March Money Madness tournament, right? We got the America sphere, Europe, and then Central, and then talk about Southeast Asia, right? The gold had to find its way somewhere or to those markets. And essentially, like if you're just putting two and two together here, someone was short the gold and needed to cover. And that's where you get into the gold squeeze that we're talking about, London, Europe, et cetera. It's in the media, it's in the airwaves. You can go find it if you will. But this is reflected, like this is primarily driven by the primary driver of those trade balance numbers, Cameron, that you had on that chart previously. Now, how do we actually like square this with what's going on the print swim lane of fiat credit or sovereign debt markets? And this is where you get into yield curves, right? As the US has forced the issue, right? It controlled the escalatory ladder. It forced everybody else in the action. Like US is playing offense here. Every other sovereign debt market is now responding to this what's now an energy squeeze. And so you think about what are the objectives or what are the goals of the military action. I think that's where I think so much of the media coverage, the commentary, et cetera, struggles to identify in Iran. It's like, is it to prohibit? Is it regime change? Or is it uh, absorbing a new market in terms of not the trade itself? We went over that last week, how little a share of trade the U.S. actually accounts for in the Persian Gulf. It's de minimis, essentially. Um, the purpose of the action, it's starting to reveal itself. By doing this, the U.S. forces the issue in another venue of this, call it war, right? And it's within capital markets, and you see it in the sovereign debt rates, right? This is where it materializes. Because without access to those oil exports and energy exports coming out of the Persian Gulf, you've got economies in Europe and Asia who are then kind of put behind the eight ball and forced to the bargaining table, if you will, to react to that pain point that the White House, the Trump administration just pressed. So you see it in the debt markets. I didn't put up individual charts, but there's key ones here. The UK and France, 10-year debt, like long into the yield curve, those have broken out against resistance lines on the yield chart, going back 4 to 5 years as the secular bear market and sovereign debt got underway, really in the post-COVID aftermath, 2022, 2023. We all remember that. But if you look at the U.S. specifically, U.S. long-term debt rates are hanging in there. They're fine. They're not low from an issuer standpoint, the Treasury's debt standpoint. That thing's not fixed yet. But you look at our partners. If you think about everything going on in the Western Hemisphere, the new Monroe Doctrine, all of that. Look what's going on in Brazil, Argentina, Mexico, et cetera. They're dollar-denominated interest rates. They're on the low end. So the Western Hemisphere and kind of its we just call it its champion, if you will, the U.S., representing with the U.S. dollar currency and global capital markets. That whole kind of trading block, they're fine, right? So what you're seeing here on a relative basis, right? It's all relative. When you're in the woods in the race against the bear, all you have to do is be faster than your friend. And so if you look into, we talked about your UK and France showing a very problematic, like if you're looking at the technicals on the yield charts, breakout in their sovereign debt rates that they're going to be forced to deal with. They are now in the position they have to play defense, right? And it's also, Japan is a friend of the U.S., but they're caught in this as well. Same thing, Australia this week, the RBA had to hike interest rates into inflationary pressures. So you can kind of think about Iran, like there's an objective there, obviously that, incorporate the dollar into trade, take control of a key bottleneck in the global trade framework that ultimately is supportive of the dollar, right? And kind of the trade block that the United States is spearheading the build out of. But the actual purpose of the action looks to be this outcome we're getting, which is putting pressure on both Europe and you could say also Asia, but not so much everybody in Asia. Let's just say Beijing, right? And that's where you see other headlines showing up. Well, the White House visit, Trump's state visit to Beijing that was scheduled for the end of the month in March, that's been postponed. So this is kind of the state of play in the process. Everybody continue to monitor the situation, right? But you're seeing things play out and headlines drop that are suggestive that, hey, there was actually some planning that went into us. There was strategy involved. And so when you see the knee-jerk reactions, hey, this is a terrible mistake. This is why would he do this? This is insane. He's compromised. Well, there's an alternative, I guess, possibility out there that there was a very structured kind of battle plan from the U.S. side. And I think that's what you're kind of seeing playing out. So all these other signals you're looking for on the crypto front, Bitcoin, et cetera, all these things are playing together. We don't know how this is going to play out, but what we do know is, what's very clear now, Europe is behind the eight ball. If you look at their pension problem,
Right.
like they have days or weeks of reserves to fund their pension obligations, if you will. Everything's pay-go. Dollars in, dollars out. There's no, besides a few countries, Netherlands, Sweden, Norway has a sovereign wealth fund. There's a few economies that are fine, but there are several, Germany, Italy, France, Spain. I'd count the UK in there as well. They're behind the eight ball here, and they don't have, years of reserves. Same thing with energy, right? They don't have access to energy reserves, if you will. They need those flows from other suppliers, whether it's the Persian Gulf or North American, South American energy supply. So by all of the actions we've seen so far, not just this year, they go into last year too, but enveloping control over Venezuela and those energy resources, enveloping Iran and energy transport, from out of the Persian Gulf. Those have put pressure on the financial systems of your kind of adversaries in this capital war. We're going to have to see a response one way or the other. The enemy, has a say. Don't expect surrender here, right? Because this is for all the marbles. But in the bigger picture, this is what's going on.
Yep.
So this, if energy or crude carriers don't start coming out of the Persian Gulf and making their way up to Europe very quick. China has a lot of oil reserves or energy reserves built up for the rainy day. Europe, I think the nature of their pension liabilities, their own energy reserves are, not well stocked. I guess we'll say they're not. They didn't come into this with the prepper mentality, if you will. Um, it looks to me like they're facing the pressure situation. The clock is not their friend, right? If this is the March Madness analogy here, it's late game situation. While your seed might have said you're the favorite here, well, you're down double digits with only a few minutes left to go. It's time to start full court pressing and turning up the energy here. So that's what I would say. Expect in the next stage of this thing. No one knows how this is going to play out, but I hope this gives a little framework of what each side is kind of sitting at in its posture and what they need to do for their next step, so you can anticipate how they might
Yep.
react.
Well, thank you, Matt. And I think that rounds it out for this week. We started talking about central bank independence and what that really means. And, Matt took us through the entire kind of stack all the way from, high level policy down to what we're seeing in the markets, and then ended it there with a little bit of kind of the broader geopolitical landscape. So, again, hopefully this is
Yep.
super useful to all of you. It is for myself every single week. It's great talking with Matt, getting to pick his brain on what's going on in the world. And with that, hopefully we'll see you all next week. As always,
Yeah.
please
No,
subscribe.
last
Matt,
Yeah, last comment there, that central bank independence. We talked about ECB being the most predominant, right? They have the most authority and control, more so than any of the other eight or nine kind of important or systemically relevant central banks in this global financial system. It's a careful double-edged sword, in my opinion, because if you're in this problem, well, it's fully on you, right, to resolve it. So be careful what you wish for here. And the worst thing you can have is uh, a peer who is, taking alternative approach, who is demonstrating and outcompete, like demonstrating better results and outcompeting you. That is what this if you make the public statements or arguments, hey, bank independence leads to higher economic growth, et cetera, better outcomes over time, et cetera. Well, the problem with that is someone else who is not doing that, who is eating your lunch. So I'd say there is a lot on the line here for the European technocrat.
great. All right, we'll see you all next week.
All right. Thanks.